Next off, I would like to introduce to you the panel discussion that we have with the title, It's the Exit, Not the End. And I would like to welcome Alexis Horowitz-Burdick, Managing Director, Sephora Digital Southeast Asia, Stephen Goh, CEO and co-founder of MigMe, Gwendolyn Regina, moderator, Director of Strategy and Business Development, Asia Pacific at Mashable. Ladies and gentlemen, please give a hand to the terrific trio!
So where's your class if you are wrong in all the right ways? All the underdogs. We will never be anything but loud and nitty gritty, dirty little freaks. Won't you come on and raise your glass? Just come on and raise your glass.
Thank you so much, Lisa. So hi everyone. I think Kylie did his job in energizing the crowd again, right? He always does that. So thank you all for sitting in for this session. I think it's a really, really important topic. It's the exit, not the end. So exits have traditionally been seen to be super glamorous. You want an exit, you want to be acquired, you want to go IPO, but at the same time, I think sometimes people don't realize that it's really just the first step of a really, really long journey. So we've got two great panelists here today, super experienced entrepreneurs who've sold a company recently, July last year, fairly recent, and Stephen, who's had two companies listed before, well, currently one now as well, and he's also acquired companies from MigMe. So let's start with the first question. Let's start philosophically. What is an exit? Anyone can start.
I think when you look at all the blogs, it's very easy to think that being a startup is all about raising money and getting a Series A. A Series A isn't a transaction in itself. It doesn't complete until that transaction's had an exit, whatever that might be, if it's successful or not successful. And I think when you look at how people talk about exits, there's either a true exit where a company's acquired outright and all the funds and capital gets released as a result of that. Or in the case of a listing, it's only ever a partial exit. A listing is very rare that the founders actually get to sell all part of their shares. Substantially, it's only an exit for either the angel investors or the venture guys. Basically, another round of investors comes in, and if you're an entrepreneur listing a company, then it's just another journey. Yeah.
Yeah, I mean, largely the same answer, nothing to add.
So, Stephen, you've listed two companies. Your latest one, MigMe, it's on Australian Stock Exchange right now. You've also acquired companies. So for you, when you say that, when you link what you just said to your experience now, you're still in the process of building MigMe. So how has that been so far for you? Going IPO, does it even make a difference?
It's been hilarious. No, but seriously. So I listed my first company, and my first company was unusual because it's a broking investment bank. And we listed 122 other companies and raised about $1 billion for other people as well. So that was, and some of the RTOs, some of the direct listings. I think the largest ended up being a $4 billion company and the like. So that was it. This company here, Mig, is a product for the listing as well. And it was just another tool to get to my larger vision. My larger vision is still being completed, which we're really excited with. Listing just ended up being part of our capital strategy to get to somewhere else. Yeah, but it was an exit for some shareholders. We used to have some fantastic shareholders in North America, some venture guys. It was an exit for them, and we secured some new shareholders, and hopefully they'll have an exit eventually. Yeah.
Okay, so how do both of you prepare for an exit like that? An exit?
Yeah, I mean, in our case, a complete exit. I don't know if there was a lot of conscious preparation, to be honest.
Okay, wait, sorry, Alexis. So complete exit meaning everyone shares exited, yeah?
Yeah,
complete 100%.
Yes. So all of my investors have
then
been
I
paid.
still think you owe me drinks at some point.
No problem. Yeah, so I don't know if I was consciously preparing. I mean, I think that at least in my situation, ensuring that the company was clean, that we were doing everything in the right way, that, I think when the opportunity, came for an exit, that we were well prepared, right? There wasn't sort of skeletons in our closet. So I think, the best thing you can do is not lie to yourself, be honest about your business. And, then when the opportunity presents itself, you don't have to feel shady.
Were you searching for an exit?
No, I think very much in the case of LVMH and Sephora, for us it was really meeting each other at the right time. It was a very fortuitous, sort of meeting. So no, we weren't consciously looking at that moment.
So Stephen, I would like to go back to the IPO topic a bit later, but since we're on the topics of M&As, for yourself, you've acquired several companies, and it's happened over the last few years or so. So for yourself, is there any preparation on your part in terms of acquiring companies? How do you integrate them? Do you have a plan to integrate the teams, the products?
Okay, so I think we've acquired about 6 companies total in the course of MIG becoming a larger company. And we're looking at maybe 100 to 150 other companies at any point in time, which is pretty cool. I think there's 2 dimensions to this. One of them is what happens when we acquire another company and what do we look for? And the second thing is how do we integrate them? For us, it comes down to, are there synergies to a larger platform business? So ultimately, the larger group is becoming a platform like, say, Line or Kakao or Tencent has become a platform. MIG is ultimately going to be a platform company. So does it actually fit inside of that strategy or not? And then secondly, we're after, and we've had some fantastic success stories, and we've made a couple of mistakes along the way. But we're after entrepreneurs who can actually run part of, there's a part of the DNA of being an entrepreneur that you're actually you're able to run yourself. And we're after people to be able to join the leadership team for the larger group. So there's a few things there. I will say one more thing when it comes to doing an acquisition. Firstly, get your shareholder agreements sorted. The whole landscape is a disaster when it comes to shareholder agreements, get your data room sorted. So make sure you always have a data room so that if anyone looks at you or you want to go and do a transaction quickly, you can actually make that happen quickly. So
when you say that, can you clarify, is it about like structurally, few shareholders and stuff like that? What exactly do you mean by that?
I think the landscape is pretty amateurish when it comes to investing in companies like this. I think people are believing the blogs too much, as a result of that, it's too easy to have accidents when it comes to whatever M&A activity actually happens on the register. Having a good shareholder agreement means that the founder can actually gracefully move on to whatever he or she genuinely wants to do in the future, not necessarily be screwed down by whatever the legacy shareholders might be. It just means that everyone's able to get to what they genuinely want rather than be held by hostage by the last person. I will say one more thing there as an example for shareholder agreements. For us, when we acquire companies, so we've been acquiring in the sort of 0 to 10 million mark by valuation. We want to see that the original shareholders get the capital back. They want to know that basically it's important to us that not everyone needs to get a 300 times exit. Not everyone needs to get a 0 outcome. Believe it or not, there's actually wouldn't it be nice to get our capital back sort of scenario. And then secondly, most of the entrepreneurs, they still have fire in their bellies. They want to live the dream. And how do we structure it in a fashion that allows them to have that? So if that's what we're acquiring companies on the basis of, how do you make sure that the company's ready for that? So it's not just simply, one disaster scenario to another disaster scenario, if that makes sense or not.
Yeah, it makes sense. So when you talk to all these companies, of all the 6 companies that you've acquired so far, have all of them been messy, shareholder-wise? Like, do you see them making mistakes?
I haven't seen. I think it's extremely rare to see a company that's actually prepared for an exit. I don't think I've seen one in this landscape because of. I suppose what's unusual about my background, because I'm both tech and have a broking and banking background. there's an opportunity for this company to go and fix things in that valuation range. But that's my opportunity. I would never recommend, I would suggest everyone else gets a better outcome if you're better prepared. I think it's on the vendor side, you're always better off if you're better prepared rather than relying on someone like me to come in and sort it out for you. It's just, yeah.
So Alexis, slightly related to Stephen's point, for yourself, when the opportunity happened in front of you, was your company prepared? You mentioned that you kind of clean up the company a little bit. When opportunity came about, you were ready kind of to receive that on the platter, right? So for yourself, the lead up to that, how was that in terms of when it came down to your lap? You're like, okay, should we jump on it immediately? When you look at your shareholder agreement, to Stephen's point, did you achieve what you wanted out of the deal?
Yeah, I don't think any of my investors are sad.
Always a good thing.
Yeah, I think what Stephen's saying, and I really agree with it, is that like have a data room. That sounds like really lame and incredibly basic, but it is a huge help. Like, are your legal agreements organized? Are your financials organized? Have you done everything on time? Is it easy to sort through? Because any good investor any good acquirer as well is going to need to see everything, right? And so, if the opportunity comes and the due diligence looks like it can take 2 months instead of 6, like so many acquisitions fall apart, right? I think this is just standard industry knowledge. And a lot of times it's because 4 months in, the company, you cannot figure out what's going on financially in the company, and no one's gonna want to acquire you if that's the case.
So, I know before the acquisition, you also had legal counsel, internal legal counsel, right? I think it's relatively rare for startups or smaller companies to have legal counsel. So why do you hire legal counsel back then?
We just more and more, we were needing legal advice, not just with investment, but for our own business. And so it got to a point where we found somebody who had great, legal startup experience prior, and was a good time for us. And again, was a really great thing for us to have internally when the opportunity for acquisition came along.
Okay, so moving on a little bit to deal structuring and deal negotiation. For yourself, Alexis, how do you solve for simplicity of terms? Like when you negotiate the acquisition, were you solving for simplicity, the timing, you want it to be done quick, or for top-line valuation?
I mean, it's the thing about an acquisition, or at least my experience is, it's not just you, right? You have investors, well, typically you would have other investors. And so it's not a selfish process. You're trying to, as the founder, you're trying to balance, the desire, if you want to have the deal happen, that with all of your investor demands and needs, right? Everybody's very vocal when there's money on the table, right? And so I think you have to balance in between the two as the founder, because you're the only person that's going to exist for both afterwards, right? So the two sides besides the founder don't care about each other, right? I had to really think about what was important for me personally, right? How am I going to stay happy and excited to be in the organization once it wasn't mine anymore? But I also had to respect to the needs, desires, demands of the existing shareholder pool. So it's a balance. I think as the founder, you need to think about what's really, really important to you, stick to your guns on those things, and be prepared to, it's a negotiation. You give on some things, they give on some things, so know the things that are really, really important to you.
And Stephen, for yourself, when you acquire companies, then how fast do you get a deal done? And in terms of negotiation process, do you find that is long drawn?
Yeah, we've acquired a company as little as 1 week before, and we've done one which I think took about 4 months. I think typically you'll ordinarily want to complete a deal within about 30 days, and within 60 days you'll want to actually have that company integrated. If you don't do that in timeline, what happens is you lose momentum very, very quickly, and it's not great for the vendor and the organisation that's been brought with it, and it's not great for the acquirer either. You really want them. If you've got 30 days to do a deal, you don't want to spend 30 days trying to figure out how many shares there are, or trying to get in touch with the last shareholder. You've got you've got days, and then you've got to make sure that the founder is energized. You want to acquire companies where the founder is in victory, not in defeat, because the last thing you want to do is take a organization on board where the person it's dead at the door. You're acquiring a company because it's onto greater things, and you want to make sure that people feel that way. So.
So for all the teams, the founding teams of the companies you've acquired, are they still around at the company in May? I think Seoul, you didn't bring on a founding team.
No, we actually did bring on the founding team. They actually consulted us for about 9 months. They were excited, and Chu Yan would work till like 2 a.m. in the morning to try and help the organization make it a success. I mean, they were absolutely fantastic. We helped them out of a Seoul shut down, unfortunately, with a range of issues that needed to be sorted. We sorted it out all for them, which was great. And ultimately, the founders walked away with something, and the original shareholders, I think they substantially got their money back in a return, which was great. I think we've had one investment where we helped their team go on to something else. So that was Match.com. I think it was a match. It was a match business. It was a games business, and the founder is now part of the Zerpass group, and I think he's gone on to better things, which is very happy for him.
In terms of at a point of acquisition and say following the 3 months after, how was it like? Was it for all the companies you've acquired? Was it did they want to stay on? Were there clashes culturally? Product-wise?
I think I would say 2/3 of them have gone very, very well, and a third, where we're learning, and I think the founders have learned as well. I think where we've made some mistakes is MIG hasn't been ready for quite that acquisition, as much as the acquiring company hasn't been ready either. We are sort of counting on one of the reasons why we make acquisitions, because we're after a founder. There's a DNA in entrepreneurs and founders that you don't get from going out and doing a search and hiring people. So we're expecting that DNA to continue. Sometimes that hasn't happened. Yeah.
So Alexis, you're at Acquirer, you're MD Sephora right now, right? Digital, right? So for yourself, was it part of the deal that you had to stay on?
I mean, I have a choice to be there, and I choose to be there. So it's fantastic, honestly. I mean, it's kind of a bit of a dream scenario in that, we are still in our offices. We run the business just like we used to run the business. But instead of having to come and beg for money, I can actually just focus on growing the business. So it's actually really an amazing time for me there.
And I think you've lost very few people in the changeover, right? Can you talk a little bit about that?
Yeah, we've had virtually no turnover since the acquisition, and I think it's because LVMH really respects our culture. They want us to keep doing what we're doing, and so we get to wake up every day with the team that I have and I've loved for 5 years in building the company, and we're still really driving the business as fast as we can, and and everybody still has that autonomy. I think that was very much the culture that they loved at Luxola. We've been able to, I think, retain that. So.
Do you work more with LVMH or Sephora?
Oh, Sephora, but owned by LVMH.
Family,
so it's a big family. So, yeah.
How was the integration process, though? I mean, even though you still work in your own offices, I'm sure there were like big management meetings, and stuff like that.
Yeah, I mean, I think like any integration ever in history, it had its bumps in the road. At large, I think the great thing is you go into a corporation and all of a sudden it's very different than having investors, right? Everybody in this room is being told, grow your top line, hire all the best people. Then you get in a corporation and it's really the opposite, right? It's why is your headcount such a big part of your revenue, right? What is your path towards profitability?
So you were questioning all of that?
Of course. I mean, it's the dirty little secret none of us want to talk about is like you have to make money as a company one day to exist, right? And so, they want to understand how you're going to do that. It's very serious.
You should read more tech blogs.
Yeah, exactly. Like, that's the thing. Like, we don't talk about it. Like, everyone brushes it under the rug, but like, you have to make money as a company, right? And so, I think the discipline in a company that large around that is, something that was kind of completely opposite from what, we had been being told by investors before. So, I think there's that. That changes. Obviously, large companies, financial reporting, all of this stuff is a demand that immediately comes, and you have to change your processes. And then I think there's the cultural piece, right? I mean, I've woken up every day for the past 5 years and done whatever I want, frankly. That's not the case anymore, right? I made a decision to sell the company, and so I think you have to, if you're going to sell, be prepared to accept that yourself, you made that decision, and then respect the people that bought you because you have a boss now, right? So, it takes, and now I'm in a good place with it, but it takes a minute, right? It takes the whole team a minute. So it's a little bumpy at first, but it's great, ultimately.
Did everyone know about the M&A on the day off, or do you give them time, your staff?
So obviously, key people that were involved knew just as long as I knew. I think you have to walk a line with your team, right? I mean, we have a big organization, just around 200 people, and you don't want people to get excited or have lots of questions or am I going to have a job tomorrow before you're really at the finish line, because things, I'm sure, as Stephen can say, they can fall apart, right? There's plenty of stories about acquisitions falling apart at the last moment, so you don't want to give that added stress to the team. So I think it's the one moment. I really believe in transparency with the organization. We're a totally flat organization still, but it's, I think, the one time where I felt like it was a bit important for me to protect the team a little bit, and then sort of towards the finish line, when I think there was no doubts, let people know, and also communicate it in a way that's exciting. I think teams can be scared of what acquisition means, right? Am I going to get fired? Am I going to have a job tomorrow? So making sure you roll it out and roll out that in the right way for the organization that's positive it's a sort of balancing act.
I want to move on a little bit to IPOs. So Stephen, for MIG, you did an RTO on Australian Stock Exchange. So one critique against RTO is that people question, is it legitimate? What do you have to say to that?
I think there are RTOs in every market that I'm aware of, and I've done work with maybe 24 stock exchanges and listed God knows how many companies. I think for MEG, we had the option to go through a direct listing through the front door. In some countries like Australia, it's entirely possible to do that, and there's a long history of extremely successful companies that have gone down that route. For us, it saved 9 months, $2 million, about several $1 million of bleed along the way, and it meant I could secure a fantastic shareholder, which is Foxconn. So it's completely a business decision. I ended up with twice as much equity, and the company's better for it. So I think for us, it was completely a commercial decision. I think if you get bogged down into the form versus the substance of what you're trying to achieve, then I would, I always look at people who sort of make comments about a whole bunch of stuff, and I would never let the form get in the way of the substance of something. I think that's the number one thing I keep people focused on.
Were you considering an acquisition of MIG?
So what do you mean by that?
So MIG getting acquired, were you considering the path, potential acquirers for MIG?
I think MIG had crossed the pathway a couple of times where we had the option for an acquisition or to go for an exit. To me, I started the thing with a view of what I wanted to achieve, and it wasn't there. And that is all. Simple as that. Yeah. To me, it's like I said I would do something, and there's no such thing as anything but that thing happening. So it wasn't the right time, and I felt I could do exactly what I intended to do. Yeah.
So Alexis, when you were raising funds, did you communicate to your investors an exit strategy at some point?
Yeah. I mean,
it's like natural, right? Investors want to see.
Investors don't want to just be your friends, unfortunately. Yeah, I mean, when you take on investors, I mean, you should also understand the gravity of what you're doing, right? I mean, you now are in debt to these people, right? They expect to make their money back. And so I think, for me, it wasn't like, oh, this is going to be the exit, but it was always about talking to my investors and talking to new investors about what the landscape was looking like, what were the opportunities, what, was evolving for us as we grew, and making sure we were aware of that.
And that included both M&A opportunities and IPO opportunities?
Yeah. We were sort of constantly evaluating. I think that was for me at least, the positive way to work with my shareholders about it was, okay, looking at maybe IPOing on the Australian Stock Exchange, right, for us was something that we were looking at, right? Other investment opportunities, acquisition opportunities. So I think you have to, once you have investors on your team, you have to be looking at the ways that you're eventually going to make them money.
After both of your exits, so the IPO and M&A, do you feel that there's greater public scrutiny on both of you as people, as CEOs?
I don't know. I think people, I don't know what perception people have of me. I hope it's a good
Does it
one.
matter?
No, yeah, it doesn't matter.
Awesome.
Really. I don't care.
Why would it be anything but?
Yeah, I don't know.
That's the best answer, yeah. Stephen?
Because I've run a listed company before and all that sort of stuff, it was for us par for the course. But I would not recommend listing a company if you on any of the markets in this region if you did not believe that you could not deliver a $1 billion company within 3 years. If you don't believe that, you should not list the company at all. The reality is it's not an exit. It ends up being it ends up being so to quote a famous line from Return of the Jedi, it's a trap. If there's no shortage of examples of companies listing either directly or indirectly of whatever it might be, and if you're not a size, then there's no liquidity, there's no replenishment of capital. The market dynamics are all wrong, and it's not an exit. 1 or 2 shareholders may exit, no one else can. I'll start with that. For us, and being in the public domain and all that sort of stuff, because I've done it before, it's neither here nor there. We always ran the company as if it was a listed company, to audit requirements, to legal compliance, for the corporate structure side of things. So it was very easy to make that transition. I don't think that's everyone's experience.
So for yourself, what has been the most difficult thing post-IPO?
The travel. But I take great photos.
You travel a lot regardless, Stephen. I see your photos all the
No.
time. And Alexis, what's the most difficult thing post-exit, post-M&A?
That changes daily, right? I don't think there's any one thing that's like, oh my gosh, like this is terrible. I think, I think shifting from not having a boss, right, to having a boss, and not, for people that know me, I'm a bit of a control freak, so, not having to give up some of that, is a bit difficult, but I think, it's very much balanced out by the opportunity and the learning. So yeah, nothing negative.
What advice?
I'll say back again to answer your question perhaps a little bit more fairly. At the end of the day, in the public domain, you're responsible for everything you say you should do, full stop. There's no such thing as you can't say one thing and do something else. The reality is that if you keep that attitude, whether you're private or listed, it doesn't make a difference. You're
Okay,
still
but
exactly
one thing
the same
regarding
thing.
listed is that
Yeah.
you can't really build. I mean, you can build for long-term value, but shareholders want short-term/medium-term value.
No, I think that's a mistake.
You think this is a mistake?
Yeah.
From who? Who's
I think it's
Not the right
I think
shareholders.
weak management gives in to weak expectations for short-term returns. If you are everything, the shareholders are there. In the case of unprofitable companies, they're there because of a future and because you're building a future. And if the future is big and large enough, say even Uber's case, fantastic. Uber is actually a cheap company. If you diminish your expectations because you're after short-run returns, well, no, Uber would be very expensive. So it comes back to management setting the right expectations, being consistent in it, and always delivering. And whether you do that privately or publicly, if you have exactly the same attitude in both circumstances, it does make a difference. if you believe that in the private domain you've got more flexibility, in the public domain then things change, then then there is a difference then. Yeah. But if you're completely consistent all the time, there's no change.
So in terms of closing comments regarding the title, is the exit not the end? What kind of advice do you have for companies here? So I say companies and not startups. Companies here looking for an exit, financially maybe.
Yeah, I mean, look, I've been a founder more than once. Like, I know how emotionally difficult and stressful it can be, especially, when you're on this kind of financial roller coaster. I think, though, like, if you're looking for an exit, look for it for the right reasons. Like, if you go into an exit just because you're in a bad financial position and that's why you do it, I don't think you're going to be happy, right? And I think that, I think that all of us as founders, like, our happiness and our well-being should be something that we also take very seriously in addition to our businesses and our financial commitments to investors. So I think, if you're looking for an exit, look for it for the right reasons. Look for a company, who you admire, that you want to work for, right? Because you're likely going to have to go to work for them for a while. So you don't want to wake up and be miserable every day, right? So, I think if you're looking for one, look for somebody for the right reasons. Look for companies where you fit culturally, where they have the same ambition as you, and hopefully a place that you'll really enjoy working. So,
Stephen?
Well, I think one of the challenges of this region as a whole is the weak exit environment. There's a mature exit environment north of Hong Kong as you exit either in China or to North America. When you swing this side, the options are far more spotty. And the like. I would not give in to the temptation of going through a listing. Even if you're Google or Facebook and the like, the reality is all those founders substantially have all their shares. They've only sold maybe this much of them. And it's only been an exit for basically either the venture shareholders or the odd employee. And that's it. If you are in this region, because the exit environment is immature, it comes down to what you've got to be a little sharper on your feet. Your business is the product, and you need to think about the organizations that may acquire it. So your business as a product, needs to be what it is. I would be very careful about the temptation about listing. Listing is not an easy process, and it's very complex. You're in the one thing that has changed in listing, rather than you raising capital from an intermittent period like this, you've got quiet periods where you're building the business. Once you're listed, you're always raising money, because what's happening is that you're always getting new investors to buy the shares as someone is selling out every single day. So as a result of that, you've got to in this environment here, you've got to be really clear about what you want and think it through. It's not an easy environment in this region. Not an easy environment.
Okay, that's it. Thank you so much, Stephen. Thank you so much, Alexis. And enjoy the rest of your day.
Okay.